Welcome to this segment of GTM Training Shorts, presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what are earnings and profits? Listen to Bill Shiraz as he provides an explanation.
What are earnings and profits, or as we like to call them, E&P? It's really a measure of a corporation's ability to make distributions out of its net assets to its shareholders without distributing any of their original capital contribution. So in other words, we say it's a corporation's ability to pay dividends. It's also the basis for Subpart F determinations in your CFCs or controlled foreign corporations, as those income inclusions are really deemed dividends. Not the same as retained earnings, but it's not also the same as taxable income either, right? We really like to say it's an economic concept. It includes items of gain, income, loss, and expense that are realized by the corporation. So a good way to think of it is a cash in or cash out perspective. Fortunately, there's no statute that offers a comprehensive method for computing your E&P, so we like to think of it as an art form. So how is E&P computed? It's determined using a hybrid approach of US GAAP accounting and tax accounting concepts and methods. So taxable income, excluding your NOLs, is generally used as your starting point for determining your E&P. As opposed to the preparation of a 5471, we talk about our CFCs, where your starting point on the form would be your US GAAP book income, and then you would make your adjustments to get to your earnings and profits. Below, we can take a look at some common add backs and subtractions. Common add back, we say, is tax depreciation because your E&P is calculated using the ADS method. A common subtraction might be a portion of your disallowed meals and entertainment expenses. We know when we're calculating our taxable income, we add back a portion of our meals and entertainment, but for E&P purposes, as the cash was outlaid for that expense, that's a good E&P deduction. Here's a more comprehensive list. We won't go over one by one, but this is a good cheat sheet when computing your E&P. When we look at our distributions and we would like to know what is considered a dividend, it really depends on your E&P balance. So once you've computed your E&P, we look at your distributions to the extent of your E&P. We start with our current E&P and then any accumulated E&P, and that amount is considered a dividend to the shareholders. Anything in excess would be a return of your initial investment or a return of capital, and any distribution that exceeds that amount could potentially be a taxable capital gain.
For more information on the U.S. tax consequences of receiving corporate distributions, please visit our website to learn about our Corporate Income Tax Compliance Fundamentals 2 program. You may also contact me via email or additional information to suggest a future topic. Don't forget to like and subscribe.